Welcome to our definitive guide on optimizing an auto loan using both refinancing and principal paydown. In this video, we will treat refinancing and principal payments as two independent decisions, and we will show you how combining them strategically can maximize your savings. We will move step by step, define key terms, build a simple framework, and then apply practical tactics. By the end, you will have a clear action plan to reduce interest, shorten your payoff timeline, and improve your monthly cash flow. Here is our agenda. First, we will establish the core rule. Next, we will define essential terms and review quick math. Then, we will provide a step-by-step plan. After that, we will discuss credit unions and rate shopping. Additionally, we will cover common pitfalls and fees. Subsequently, we will compare refinance versus principal paydown versus doing both. Then, we will visualize timelines and scenarios. Afterward, we will test your understanding with quick quizzes. Finally, we will summarize takeaways and give you next steps. The core rule is to treat refinancing and principal paydown as two independent decisions. First, evaluate refinancing solely on whether your current APR is high relative to what your credit can qualify for, often above 6%. If your credit is strong, typically 760 or higher, consider refinancing immediately and prioritize credit unions. Next, separately decide whether to apply a lump sum toward principal only after confirming your emergency fund is intact. Finally, the optimal move often combines both. Lock in a lower APR through refinancing, and then apply your extra funds to principal for maximum savings and shorter payoff. Before we proceed, a brief disclaimer. This video is for educational purposes only and does not constitute financial, legal, or tax advice. Terms and outcomes vary by lender, state, and individual contracts. Therefore, you should verify details directly with your lender and consult a qualified professional regarding your specific circumstances. Let's define terms so we can move efficiently. A PR is the annual cost of borrowing. Refinancing means replacing your existing loan with a new loan, potentially at a lower APR or different term. Principal is the outstanding balance you owe. A lump sum principal payment is an extra payment applied directly to your principal, which shortens your payoff time and reduces interest over the life of the loan. An emergency fund is your safety buffer. You should secure this before sending extra cash to debt. Interest is calculated on the remaining principal, which means that reducing principal earlier saves interest over every remaining month. Refinancing lowers the rate applied to that balance, creating savings on all subsequent payments. Consequently, combining a lower APR with a reduced principal balance compounds the benefit. The standard amortization formula shows how the monthly payment depends on the monthly interest rate, the present value of the loan, and the number of months remaining. We will not compute exact figures here, but the relationships are what matter. Reduce the rate and the balance to shrink total interest. Here is the action plan. First, check your credit scores and reports, ideally targeting a score of 760 or higher. Next, pre-qualify at multiple credit unions and compare rates and terms. Then, evaluate the total cost after fees to ensure the refinance creates real savings. If your current APR is high, refinance first to lock in a better rate. Afterward, confirm your emergency fund is fully funded. Finally, apply your lump sum to principal on the new, lower APR loan. To keep momentum, set up autopay and consider rounding up your payments to accelerate payoff further. This flowchart shows the two independent branches. First, on the refinance branch, you ask whether your APR is above 6%. If yes, and your credit is strong, you proceed to refinance now, prioritizing credit unions. If no, you still pre-qualify and monitor rates. Meanwhile, on the lump sum branch, you ask whether your emergency fund is ready. If yes, you apply the lump sum to principal. If not, you pause and build your cash buffer. Finally, both paths converge to the dual approach, which combines a lower APR with a reduced principal for maximum savings. Note that a principal payment by itself typically does not reduce your required minimum monthly payment unless your lender re-amortizes the loan. Credit unions frequently offer lower auto refinance rates, even when general market rates are high. Their member-focused approach can be more flexible. Many allow soft pull pre-qualification, so you can compare without immediately affecting your credit scores. Ask about autopay discounts and available term options. If your credit profile is strong, Targeting an annual percentage rate in the 4 to 5% range is often realistic with credit unions. Be cautious about fees and traps. First, verify whether your existing loan has prepayment penalties or payoff fees. Second, examine any origination fees or title and list and transfer costs on the new loan. Third, confirm whether GAP insurance or extended warranties transfer correctly when you refinance. Fourth, make sure extra payments are applied to principal only, and do not merely advance your due date unless that is your goal. Finally, coordinate payoff timing to avoid overlapping payments while your old loan is being paid off by the new lender. Let's compare options side by side. Refinancing reduces your APR, so every remaining dollar you owe becomes cheaper. It can lower your required monthly payment, especially if you extend the term, though extending the term can increase lifetime interest if you are not careful. Refinancing is worth exploring even if you do not have extra cash today. Meanwhile, principal paydown reduces your balance directly and saves interest over the remaining months. However, it typically does not change your required minimum payment unless your lender re-amortizes the loan. After securing an emergency fund, applying a lump sum to principal is powerful. Combining both strategies, refinancing and principal paydown, usually delivers the greatest total savings. This scenario table helps prioritize actions. If your APR is at least 6% and your credit score is 760 or higher, refinancing first is often the best move, and then you can apply the lump sum. If your APR is high, but your credit is below 700, begin by pre-qualifying and improving credit, then refinance and later add a lump sum. If your APR is already below 5% and your emergency fund is solid, a lump sum may be the more impactful lever. If cash is tight and you lack an emergency fund, pause prepayments and build your buffer first. If you need a lower monthly payment, refinance to reduce the payment, and then, when possible, add extra principal to accelerate payoff. This timeline illustrates a practical sequence. On day 1, you check your credit and list prospective credit unions. Over days 2 and 3, you pre-qualify and compare APR offers. On day 4, you select a lender and gather necessary documents. Between days 5 and 7, you submit the application and receive approval. During days 8 through 10, funding occurs and your old loan is paid off. On day 11, you set up your new account, enable autopay, and apply your lump sum to principal. After day 12, you continue monitoring, consider rounding up payments, and track your payoff progress. Quiz time. The question is, what is the smartest way to think about refinancing and a lump sum principal payment? Option A, they are one combined decision, do one or the other. Option B, they are independent decisions you should optimize separately. Option C, only the lump sum matters. Refinancing is optional in all cases. Option D, only refinancing matters. Lump sums rarely help. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that they are independent decisions you should optimize separately. First, decide whether refinancing is beneficial based on your current APR and your credit profiles. Separately, decide whether you should apply a lump sum to principal after confirming your emergency fund. Combining both typically maximizes savings. Here is the second quiz question. Does a lump sum principal payment automatically lower your required minimum monthly payment on your current auto loan? Option A, yes, always. Option B, no, not unless the lender re-amortizes the loan. Option C, only if you pay more than 20% of the balance. Option D, it depends on the car's value, not the loan. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is no, not unless the lender re-amortizes the loan. A lump sum reduces interest and accelerates payoff, but the required minimum monthly payment usually stays the same under the existing amortization schedule unless the lender recalculates it. To execute well, compare total cost rather than just the advertised APR. Always ask how lenders apply extra payments and specify that you want them applied to principal only. And if you need lower payments today, consider refinancing to a slightly longer term, but continue paying extra so you still finish early and cut total interest. If rates may drop later, consider pre-qualifying again in a few months. You do not need to wait years to revisit your rate. These are the key takeaways. Treat refinance and principal paydown as separate levers. If your APR is high and your credit is strong, refinance now, prioritizing credit unions. Ensure your emergency fund is in place before applying extra cash to debt. Then, apply your lump sum to principal to speed up payoff and cut interest. This dual approach usually maximizes savings and gives you the most control over your monthly finances. To summarize, first, secure a better APR by refinancing, ideally through a credit union. Second, ensure your emergency fund is adequately funded. Third, apply your lump sum directly to principal on your new, lower interest loan. Finally, automate payments and monitor your progress to stay on track and realize the full savings potential. Thanks for watching. If this video helped you, please like it, share it with someone who could benefit, and subscribe for more practical money strategies. Also, tell us about your refinance and principal paydown results in the comments so we can learn together.